wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This here is the Market Color Podcast, where we keep you up to speed with the latest developments in the financial markets. And we do that by first giving you a broad overview of the global financial markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 169. And in this episode, we're reviewing the performance of the global markets during the 29th week of 2025. And that is from Monday the 14th to Friday the 18th of July. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. We kick it off in the United States, where consumer prices rose in the month of June as President Trump's tariffs began to slowly work their way into the U.S. economy. The Bureau of Labor Statistics reported on Tuesday that the Consumer Price Index, which is a broad measure of the cost for a standard basket of goods and services, this increased by 2.7% on an annual basis, which was in line with market expectations, but was the highest rate of inflation since February 2025 and still remains above the Federal Reserve's target rate of 2%. Excluding volatile food and energy prices, the core rate of inflation picked up by 2.9% on an annual basis, which again was in line with market estimates. Before the June reading, inflation had been gradually moving lower in 2025, despite concerns that trade tariffs would drive prices higher. However, the uptick in June inflation suggests that tariffs could finally be having an impact on consumer prices. Over to the United Kingdom, where according to data released by the Office for National Statistics on Wednesday, the annual rate of inflation in the United Kingdom came in much hotter than expected at 3.6% in the month of June. Economists polled by Reuters had anticipated a much lower rate of 3.4%, following a similar reading in the previous month of May. Meanwhile, core inflation, which excludes volatile food and energy prices, this increased at an annual rate of 3.7%, and this was up from 3.5% in the month of May. The UK Finance Minister, Rachel Reeves, said that the inflation data showed that working class people were still struggling with the cost of living and said that the government had more work to do in order to ease pressure on consumers. The Bank of England will also take this data into consideration as it tries to determine the future direction for interest rates amidst persistently high inflation and lackluster economic growth. And over to China, where the latest data shows that China's economy grew at a faster than expected rate in the second quarter of 2025, keeping it on track to achieve its full-year growth target of 5% and easing pressure on policymakers to step up additional stimulus. According to China's National Bureau of Statistics, domestic consumption contributed to 52% of the country's gross domestic product in the first half of 2025. China's gross domestic product increased by 5.2% in the second quarter, beating economists' estimate for a growth of 5.1%, but still represented a slowdown from a growth of 5.4% that was recorded in the first quarter of 2025. On Wall Street this past week, the Dow Jones Industrial Average slid on Friday after President Trump pushed for higher tariffs on the European Union. Trump is now demanding a minimum tariff of between 15 to 20% in any deal with the European Union, and the European Union is attempting to reach a trade deal with the United States before the deadline on the 1st of August, when Trump has vowed to implement a 30% tariff on the trading bloc. Traders also digested the latest economic data, which showed that consumer sentiment improved in the month of July, despite concerns about tariff-induced inflation. In response, the 30-stock Dow fell by 142 points to close the week at 44,342, whilst the S&P 500 dipped slightly after hitting a record high earlier in the day before settling at 6,296, and the tech-heavy Nasdaq Composite ticked up marginally to end the session at 20,895. In the U.S. government bond market, U.S. Treasury yields moved lower on Friday as investors digested the latest economic data and factored in the ongoing tariff war, which shifted towards the European Union this past week. According to a report from the Financial Times, President Trump escalated his demands on the European Union and is now demanding a minimum tariff of between 15 to 20%. In the meantime, the University of Michigan's survey of consumers for the month of July showed that consumer sentiment improved to its highest level since February, as the consumer outlook for inflation also fell to its lowest level since then. In response, the yield on the benchmark 10-year Treasury bond declined by 4 basis points to 4.42%, whilst the yield on the shorter-dated 2-year Treasury note fell by a similar margin of 4 basis points to settle at 3.87%. For your information, 1 basis point is equivalent to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil held steady on Friday amid mixed economic data from the United States and concerns that the European Union's latest sanctions against Russia could reduce the global supply of oil. On the data front, U.S. inflation data came out much hotter than expected, whilst consumer sentiment improved in the month of July as inflation expectations continued to decline. Despite lower inflation expectations, the actual inflation data was much higher than expected, making it more difficult for the Federal Reserve to determine the future direction of interest rates. Meanwhile, the European Union reached an agreement on additional sanctions against Russia, which includes measures aimed at weighing down Russia's oil and energy industries. In response, both crude oil benchmarks were on track for a loss of about 1% this past week, as the global benchmark Brent crude fell by 20 cents on Friday to close at $69.32 a barrel, whilst the U.S. benchmark West Texas Intermediate crude lost about 16 cents to settle at $67.38 per barrel. In the precious metals market, the price of gold rose on Friday, driven mainly by a weaker US dollar, plus the ongoing geopolitical and economic uncertainty that continues to boost demand for this safe haven asset. The dollar index was down by about 0.5%, making gold cheaper for buyers holding other currencies. Earlier in the week, President Trump said that he was not planning to fire the Federal Reserve Chairman, but still left the option open as he continued to criticize Powell for not cutting interest rates. Nevertheless, market players are anticipating at least 2 rate cuts totaling to 50 basis points before the end of this year. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment, given that it doesn't provide a regular yield like a bond. In response, the price of spot gold rose by 0.4% to settle at $3,353 per ounce. In the cryptocurrency market, Ether stole the spotlight from Bitcoin this past week as it rose by about 18% as President Trump signed the Genius Act that provides a legal framework for issuing stablecoins. For your information, stablecoins are digital tokens that are pegged to a certain asset, usually the US dollar, and are designed to maintain a constant value, hence the name stablecoins. Examples of stablecoins are USD Tether and USD Coin. On Thursday, the U.S. House of Representatives passed the Genius Act, and President Trump signed it into law on Friday, making it the first major crypto legislation in the United States. On Wednesday, exchange-traded funds that track the price of Ether saw a single-day record of net inflows totaling to $726 million, followed by another $602 million on Thursday. According to CoinMetrics, the price of Ether advanced by about 18% this past week, bringing its 2-week gains to about 44% before coming to a close at $3,506 per Ether. We now change scene to the Kenyan financial markets, and as is the norm, we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained static versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24, which was the same rate that was recorded over the past 2 weeks. Meanwhile, the sterling pound was priced at 173.11 and the euro was valued at 150.23. And on the regional front, one Kenya shilling was changing hands for 27.72 Ugandan shillings and 20.16 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.14. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined marginally by $16 million for a grand total of $11.18 billion, which is equivalent to 4.9 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this was stable at 9.64%, compared to a rate of 9.61% that was recorded the previous week, but was still pretty much in line with the central bank rate at 9.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 15.5 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 17th of July, and the central bank received bids totaling to 27.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 116%. The central bank ended up accepting almost the entire amount, taking in about 24.1 billion shillings, and the results of the auction were as follows. The 91-day rate slid by 1.3 basis points to average out at 8.12%, whilst the 182-day rate dipped by about 1 basis point to settle at 8.43%, and the 364-day rate was stable at an average weighted rate of 9.72%. On Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as at May 2025 stood at 11.5 trillion shillings, and this was divided between domestic debt, which stood at 6.2 trillion shillings, and foreign external debt that was valued at $41.07 billion, which is equivalent to 5.3 trillion shillings. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product, and given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue, and this week we are looking at the listing of the first equity-based exchange-traded fund at the Nairobi Securities Exchange. The Nairobi Securities Exchange marked a significant milestone this past week with the dual listing of the Satrix MSCI Emerging Markets Exchange Traded Fund. For your information, MSCI stands for Morgan Stanley Capital International. This exchange-traded fund is issued by Satrix, which is a South African fund manager, and signals a shift in how domestic investors access the global financial markets by providing Kenyans with direct exposure to global equities. This particular exchange-traded fund tracks the MSCI Emerging Markets Index, which includes companies from over 20 countries such as China, India, South Africa, Brazil, and Taiwan. Through this single investment vehicle, Kenyan investors can now gain exposure to a diversified portfolio of international stocks and will be able to do so without the risk of currency fluctuations, given that the fund will be denominated and traded in Kenya shillings. The listing of the Satrix Global Exchange Traded Fund is a landmark achievement for the Nairobi Securities Exchange in its ongoing endeavor to modernize Kenya's capital markets. It also reflects the growing global confidence in Kenya's financial infrastructure and operational capacity. The listing reflects the Nairobi Securities Exchange dual role as a regulator and a market promoter as it seeks to attract a wider pool of domestic investors. The exchange-traded fund introduces a new product category and supports the long-term strategy to expand investor choice and enhance market liquidity. For many individual investors, exchange-traded funds provide a simplified and relatively low cost of diversifying their portfolios compared to purchasing global equities on an individual basis. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share it with your family and friends and also help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, to get something you've never had, you have to do something you've never done. Think about it. Thank you, and God bless.